Every few years, a Latin American economy collapses. Argentina in 2001, Venezuela starting in 2014, Ecuador in 1999, Brazil's lost decade, Mexico in 1994. The pattern is so consistent you can almost set your calendar by it. Somewhere in the region, right now, the conditions are building. Debt is accumulating, reserves are draining, political tensions are rising, the fuse is lit, we just don't know how long it is. Most analysts focus on the obvious candidates. Argentina is always in crisis. Venezuela has already collapsed. These are the usual suspects, and they deserve attention. But the next collapse might come from somewhere unexpected. A country that seems stable. A country that the markets haven't noticed. A country where the warning signs are flashing, but nobody's watching. Today, I'm going to do something risky. I'm going to make a prediction. Based on economic indicators, political dynamics, and structural vulnerabilities, I'm going to identify which Latin American country is most likely to face a severe economic crisis in the next 2 to 3 years. This isn't clickbait speculation, this is analysis. The same indicators that predicted previous collapses are present somewhere today. The question is where? Let me show you the methodology, then I'll show you the verdict. 1. The collapse indicators. Before we can predict the next collapse, we need to understand what causes collapses. Economic crises don't happen randomly, they follow patterns. Certain conditions consistently precede catastrophic failures. Let's identify them. Indicator 1. Debt dynamics. When a country's debt grows faster than its ability to service it, crisis becomes inevitable. The key metrics are debt-to-GDP ratio, but also the trajectory. A country with 60% debt to GDP that's falling is safer than a country with 40% that's rising rapidly. Also crucial, the composition of debt. Foreign currency debt is more dangerous than local currency debt. Short-term debt is more dangerous than long-term debt. Debt held by volatile foreign investors is more dangerous than debt held domestically. Indicator 2. External vulnerability. Countries that depend on foreign financing are exposed to sudden stops. When global risk appetite shifts, capital flees. The metrics here are current account deficit, reserve coverage, and short-term external debt. A country spending more than it earns, with low reserves and lots of debt coming due, is one bad news cycle away from crisis. Indicator 3. Commodity dependence. Countries that rely heavily on one or two commodity exports are vulnerable to price swings they can't control. When copper crashes or oil plummets, these economies collapse. The metrics are export concentration and the share of government revenue from commodities. Indicator 4. Political instability. Economics and politics are inseparable. Governments under pressure make desperate decisions. Polarized societies can't implement reforms. Upcoming elections create uncertainty. The indicators here are harder to quantify. Approval ratings, institutional strength, upcoming electoral cycles, social unrest. Indicator 5. Currency pressure. Before a crisis hits, it usually shows up in the currency. Rapid depreciation, depleting reserves, widening gaps between official and parallel exchange rates. These are warning signs. The metrics are reserve trends, currency volatility, and real exchange rate misalignment. Indicator 6. Banking system stress. Financial crises often start in banks. Rising non-performing loans, credit contractions, and deposit flight signal trouble. A weak banking system amplifies economic shocks. Now let's apply these indicators to the region. 2. The usual suspects. Let me quickly address the obvious candidates, the countries everyone already worries about. Argentina. Argentina is always in crisis or about to be. The country has structural problems that predate any current government, chronic inflation, recurring debt defaults, and boom, bust cycles. Under Milei, Argentina is attempting radical adjustment. Early results are mixed. Inflation has slowed from its peak but remains extremely high. The fiscal adjustment has been severe. Poverty has increased. Will it work? Possibly. Milei's shock therapy might stabilize the economy if Argentines tolerate the short-term pain, or it might trigger a political backlash that derails everything. But here's the thing. Argentina is priced for crisis. Everyone knows Argentina is risky. Bond spreads reflect this. Investors are cautious. There's no surprise coming. The dangerous collapses are the ones nobody expects. Venezuela. Venezuela has already collapsed. The economy contracted by 80% over a decade. Millions fled. The country hit bottom and has been scraping along it for years. There's nowhere further to fall. Venezuela might continue its slow-motion humanitarian disaster, but it won't collapse in the traditional sense. It already did. Ecuador. Ecuador has vulnerabilities. Dollarization limits policy flexibility, debt levels are elevated, and political instability is chronic. But Ecuador has survived repeated crises without complete collapse. The dollarization, while constraining, also provides stability. The country muddles through. Let me turn to less obvious candidates. 3. Bolivia, the quiet crisis. Here's where it gets interesting. Bolivia doesn't make international headlines. It's a small, landlocked country that most investors ignore, but the indicators are flashing red. The reserves collapse. In 2014, Bolivia had over $15 billion in international reserves, comfortable for a small economy. By late 2024, reserves had fallen below $2 billion. Much of what remains is in gold that can't be quickly liquidated. This is a catastrophic decline. Bolivia has essentially run out of dollars. The currency peg? Bolivia maintains a fixed exchange rate, about 6.9 Bolivianos to the dollar. This peg has held since 2011, but pegs only hold when you have reserves to defend them. A parallel market has emerged. The street rate diverges from the official rate. This is the classic sign of a peg about to break. When Bolivia's peg breaks, and it likely will, the economic shock will be severe. Import prices will spike. Inflation will surge. Dollar-denominated debts will become unpayable in local terms. The gas dependency. Bolivia's economy was built on natural gas exports, primarily to Brazil and Argentina. Gas provided government revenue and foreign exchange. But production is declining. The major fields are depleting. Investment in exploration has lagged. Brazil is developing its own gas production. Argentina, Bolivia's other major customer, is developing vaca muerta. Bolivia's cash cow is dying, and there's nothing to replace it. The political situation. Evo Morales, the former president, is fighting with Luis Arce, the current president, for control of their political movement. The ruling party is splitting. Elections are coming. Political instability makes economic management harder. The temptation to spend reserves on short-term political survival grows. The verdict on Bolivia. Bolivia meets almost every collapse indicator: reserves depleted, currency peg unsustainable, export base shrinking, political instability rising. The timing is uncertain. Bolivia might limp along for another year or two, but without a dramatic change in circumstances, a severe crisis is coming. The only question is when. My assessment: Bolivia is the highest probability for a significant economic crisis in the next 18 to 24 months. 4. Colombia, the slow deterioration. Colombia is more important than Bolivia. Larger economy, more international integration, more at stake. And Colombia is showing troubling signs. The fiscal deterioration. Colombia's debt-to-GDP ratio has risen from 50% pre-pandemic to over 60% today. That's manageable by some standards, but concerning for a country with Colombia's risk profile. More worrying is the trajectory. Deficits remain elevated. The current government has struggled to pass tax reforms. Spending pressures are intense. The current account deficit. Colombia consistently spends more than it earns internationally. The current account deficit runs 3 to 4% of GDP. This requires constant capital inflows to finance. When global risk appetite turns, Colombia is vulnerable to a sudden stop. The political uncertainty. President Gustavo Petro is Colombia's first leftist president. His reform agenda has faced fierce opposition. His approval ratings have fallen. Relations with Congress are poor. More concerning, Petro has made statements questioning central bank independence. He's clashed with the Attorney General. Institutional tensions are rising. Colombia has historically had strong institutions by regional standards. If those institutions weaken, the country loses a crucial buffer against crisis. The peso pressure. The Colombian peso has been among the most volatile currencies in the region. It's weakened significantly from pre-pandemic levels, though with some recent recovery. Central bank reserves are adequate but not abundant, about $60 billion covering roughly 8 months of imports. The commodity exposure. Colombia depends heavily on oil and coal exports. Both face long-term headwinds from energy transition. Near-term prices are volatile. A sustained decline in commodity prices would stress government finances and the current account simultaneously. The verdict on Colombia. Colombia isn't on the verge of immediate collapse. The institutions are stronger than Bolivia's. The reserves are more adequate. But Colombia is deteriorating. Each year of fiscal slippage and institutional erosion increases vulnerability. If a global shock hits, if commodity prices crash, or US interest rates spike, Colombia has less cushion than before. My assessment: Colombia is a medium probability risk for a significant crisis in the next 2 to 3 years, and a higher probability risk for a longer term decline if current trends continue. 5. Peru, the chaos factor. Peru presents a different kind of risk: political chaos that could trigger economic collapse. The governance crisis. Peru has had 6 presidents in the last 6 years. Institutional legitimacy has collapsed. Congress and the executive are in permanent conflict. Approval ratings for all institutions are in single digits. This isn't normal political dysfunction. This is systemic breakdown. The Boluarte situation. President Dina Boluarte took power after Pedro Castillo's impeachment and arrest. Her legitimacy is questioned by many Peruvians. Protests have been severe, particularly in southern Peru. The death toll from protest repression exceeded 60. The country is deeply divided between Lima and the regions, between right and left, between those who accept Boluarte and those who don't. The economic implications. Political chaos has economic costs. Investment is deterred. Policy is inconsistent. Long-term planning is impossible. Peru's economic fundamentals are actually decent. Debt is moderate. Reserves are adequate. The central bank is competent. Mining exports provide foreign exchange. But economics requires governance. A country that can't form stable governments can't implement economic policy. Eventually, the political chaos infects the economy. The social pressure. Peru has massive inequality. Mining wealth has not been shared broadly. Rural and indigenous communities feel excluded. This feeds the political instability. Without addressing these grievances, stability is impossible, but addressing them requires governance capacity that doesn't exist. The verdict on Peru. Peru's risk is different from Bolivia's. The economic fundamentals are stronger. The collapse, if it comes, would be politically driven rather than economically driven. But political collapses can be more sudden and unpredictable. A single event, a coup attempt, a massive protest, an assassination could trigger rapid deterioration. My assessment: Peru is a moderate probability for crisis, but with high uncertainty. The situation could stabilize or could explode. The volatility itself is the risk. 6. Chile, the unthinkable. Chile is Latin America's success story. Including it in a collapse analysis seems almost absurd. And yet, the constitutional chaos. Chile's 2019 social explosion revealed deep fractures. 2 constitutional processes have failed. The political system is fragmented. Traditional parties are weakened. This instability has costs. Investment has slowed. Growth has disappointed. The forward momentum that defined Chile for decades has stalled. The copper dependency. Chile depends on copper for about half of its exports and a significant share of government revenue. Copper prices are volatile. The country has built stabilization funds to buffer commodity swings, and they help. But prolonged copper weakness would stress finances. The growth problem. Chile grew rapidly for decades. That growth has slowed dramatically. Potential GDP growth estimates have fallen. Without growth, the social pressures that exploded in 2019 will only intensify. The verdict on Chile. Chile is not going to have an economic collapse in the traditional sense. The institutions are too strong, the reserves are too deep, the debt is too low. But Chile could experience a slow decline, a gradual loss of the dynamism that made it exceptional. Not a crisis, but a fade. My assessment: low probability of traditional collapse, moderate probability of continued stagnation and political instability that gradually erodes Chile's advantages. 7. Panama, the hidden vulnerability. Panama is small but strategically important, and it has risks that few discuss. The financial sector exposure. Panama's economy depends heavily on financial services, much of it related to its role as an offshore center. International pressure on financial secrecy could shrink this sector. The canal dependency. The Panama Canal is the country's crown jewel, but it's vulnerable. Drought has already forced transit reductions. Climate change threatens water levels in Gatun Lake. Reduced canal revenue would stress government finances. The real estate bubble. Panama City has seen massive real estate development. Much of it is financed by questionable money. A global crackdown on money laundering could deflate the property market. The verdict on Panama. Panama is unlikely to face a traditional economic crisis, but it's vulnerable to structural shifts in the global economy that could undermine its niche. My assessment: low probability of imminent crisis, moderate probability of longer-term structural challenges. 8. The wildcard: global conditions. Any prediction about Latin American economies must account for global factors. U.S. interest rates. When the Federal Reserve raises rates, capital flows out of emerging markets. Latin American currencies fall. Dollar-denominated debt becomes harder to service. The rate environment in 2025 to 2026 will significantly impact which countries face pressure. China's economy. China's slowdown affects commodity exporters throughout Latin America. Copper, soybeans, iron ore, these prices depend heavily on Chinese demand. A Chinese hard landing would devastate South American exporters. Global risk appetite. In risk-on environments, money flows to emerging markets. In risk-off environments, it flees. Latin America is particularly sensitive to these swings. Commodity prices: oil, copper, soybeans, lithium. These prices will determine which commodity exporters thrive and which suffer. Prices are inherently unpredictable. The country that looks stable today could be in crisis tomorrow if its key export crashes. 9. The final assessment. Let me rank the risks. Highest probability of significant crisis: 18 to 24 months. Bolivia. The indicators are too clear. Reserves exhausted. Currency peg unsustainable. Export base declining. Political instability rising. Bolivia is heading for a severe adjustment. The only question is whether it's managed or chaotic. Elevated probability of crisis: 2 to 3 years. Colombia. The deterioration is slower but real. Fiscal pressures, current account deficits, and political uncertainty create vulnerability. A global shock could trigger something worse. Significant uncertainty with crisis potential. Peru. The political chaos is severe. Economic fundamentals are stronger, but governance breakdown could overwhelm them. The risk is less predictable but real. Lower probability but worth watching. Ecuador. Always fragile. Chile. More likely stagnation than crisis. Panama. Vulnerable to structural shifts. The obvious candidates. Argentina will continue to be volatile, but it's a known risk. Markets are positioned for it. Venezuela has nowhere further to fall. 10. What to watch. If I'm right about Bolivia, what are the signs that crisis is imminent? Reserve reports. Bolivia publishes reserve data with a lag. Watch for continued declines toward the $1 billion threshold. Parallel exchange rate. The gap between official and street rates will widen before the peg breaks. A gap exceeding 30–40% signals imminent devaluation. Fuel shortages. Bolivia subsidizes fuel. As dollars run out, imports become difficult. Fuel lines would signal the system breaking. Political rupture. If Evo Morales and Luis Arce's conflict turns violent or leads to early elections, all bets are off. IMF engagement. If Bolivia approaches the IMF, crisis is acknowledged. The terms of any program would be harsh. For Colombia, watch. Risk spreads. If Colombian bond spreads widen significantly relative to peers, markets are signaling concern. Central bank reserves. Declining reserves would indicate capital flight. Political developments. Further institutional erosion, especially regarding central bank independence. Conclusion. The prediction. I'll make it explicit. Bolivia is the most likely candidate for the next significant Latin American economic crisis. The timeline is 18 to 24 months. The form will likely be a currency collapse following reserve exhaustion, leading to inflation, import shortages, and severe recession. Colombia is my second concern. The timeline is longer, 2 to 3 years, and the crisis would be less dramatic but potentially more consequential given Colombia's size and importance. Peru is the wild card. Political chaos could trigger economic collapse at any time, or the situation could muddle along indefinitely. Am I certain? No. Predictions are hard, especially about the future. Any of these assessments could be wrong. But the methodology is sound. The indicators that preceded past crises are present in these countries today. Something is going to happen somewhere. The value of this analysis isn't certainty, it's awareness, knowing where to look, understanding the warning signs, being prepared for possibilities that markets might be ignoring. The next Latin American collapse is coming. It always does. The question is whether we see it coming or whether it catches us by surprise. Based on the evidence, I've told you where I'm looking. Let's see if I'm right. If this analysis gave you a framework for understanding economic risk, hit that subscribe button, because when the crisis comes, you'll want to understand why. See you in the comments, and remember, the most dangerous economic crises are the ones nobody expects. Pay attention to the countries nobody's watching.